Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Big banks beat. UBS and Santander smash estimates for first quarter net income. Volvo Cars and Deutsche Bank also report this hour. We'll speak to top executives from both companies. Oil, meanwhile, fluctuates on a report that President Trump is preparing for a lengthy blockade of the Strait of Hormuz. Traders weigh the UAE's shock exit from OPEC and what it means for the cartel's influence. Plus, treading carefully. Investors on tenterhooks ahead of a bumper day of earnings from the US tech giants and, of course, the Fed rate decision. Well, a very good morning. Welcome to the programme. A busy day both in earnings and with the Fed decision later on. In the run-up, take a look at stocks. We're in flux around the world. Asian stocks and European futures now in the green, and Nasdaq futures too, after the index dropped 1% yesterday on that report that OpenAI failed to meet its own goals, so reigniting capex concerns across broader tech. But the Nasdaq back on its feet, or set to be, from the futures picture. Flipping over to the cross-asset picture, as ever, one eye on oil. We have Brent now above $111 a barrel, up 0.1%. WTI is down 0.3 at 99.63, but we're factoring the UAE's departure from OPEC next month. President Trump saying that Iran's asked the US to lift that naval blockade of the Strait of Hormuz. On the Wall Street Journal reporting that Trump's told his aides to prepare for an extended blockade. Now, remember, it is a holiday in Japan today, so there's no trading cash treasuries just yet. We did see that yield spike on the expectation that higher oil prices will drive up inflation. That curbing Fed cut bets. But euro dollar pretty steady at 117 as we head into tonight's Fed decision. Speaking of which, let's take a look at the risk events on the docket for today in terms of inflation here in Europe. At 8 a.m. London time, we have Spanish CPI for April at 8 a.m. and at 1 p.m. London time, we have German April CPI. At 7 p.m, it's that Fed decision, a hold expected, but the political drama around Kevin Warsh replacing Jay Powell expected to overshadow the policy debate. And if this is Powell's last presser, what clues is he going to drop about his future as a governor, if not as chair? Finally, as I say, a busy day for earnings already out of Europe. We've had UBS and Santander. We'll get to Deutsche, Volvo Cars and Mercedes in just a moment. But later on stateside, we'll get the bulk of the Mag 7. Alphabet, Amazon, Meta and Microsoft all reporting. So lots to bring you. Let's set you up for the day ahead. We begin with earnings breaking out of Germany from Deutsche Bank, and the redhead is first quarter fixed sales and trading revenue coming in just shy of estimates, 2.85 billion euros. The estimate was for 2.87 billion euros. But elsewhere, lots of beats here. So for first quarter net revenue, 8.67 billion euros. That's a beat. Fixed sales and trading revenue, 2.9 billion. That's a beat. First quarter pre-tax profit, 3.04 billion euros. That's a beat as well. Now, our analysts have flagged Deutsche's 26 billion euro private credit exposure. They're looking for a more detailed assessment of the associated risks. The question really is to what extent that's offset by the volatility-driven trading. We've also seen that Deutsche sees its full-year private bank net revenue higher than 2025. So lots of questions for the CFO, Raja Akram. He'll be speaking to Bloomberg's Oliver Crook in just under half an hour. We stay in Germany now and turn to the auto space because we've also got breaking earnings from Mercedes. Analysts flagging before these results the downside risk from its China performance and headwinds coming from tariffs. But the redhead is first quarter cars adjusted EBIT coming in at 933 million euros, a beat on the estimate of 751.3 million euros. Earnings sliding slightly, though, on the China slump ahead of the model offensive, but EBIT, as I say, beating estimates here. And so these are the results from Mercedes, and we can dig into those as well later in the programme. We should also, though, stay with cars and turn to Sweden because we've got results from Volvo Car as well. First quarter revenue meeting estimates. They say they aim to return to volume growth on a year-on-year basis for the full year. First quarter retail sales coming in lower by 11%, and we're seeing EBIT margin at 2.2%, so a beat on the estimate of 2.05%. We're going to be speaking to the CEO of Volvo Cars, Hakan Samuelsson, and that conversation coming up later in the programme, so don't miss that at 6:40 a.m. London time. Well, staying with earnings, we have also already heard from UBS this morning, reporting a strong first quarter profit number, comfortably beating expectations. The Swiss lender also reaffirmed its plan for up to $3 billion in share buybacks this year. For more, let's bring in Bastian Benrath-Wright, our economy and government reporter over in Zurich. Bastian, good morning to you. Just give us your key takeaways from these results.
Good morning, Lizzie. Yeah, the key takeaway, the headline is really this is a very, very profitable bank. You said it, first quarter net income was just over 3 billion, comfortably beating expectations. But what is probably more important to investors is that they have reaffirmed their target of exceeding the $3 billion share buyback figure, which they have given earlier in the year. They've done 0.9 billion in the first quarter, so they remain on track to fulfill this number, 3 billion number, by the third quarter. And they have said they are willing to do more, intending to do more, depending on the how the business progresses, whether like these successes like we've seen them today go on. What is really important to note here is the money at UBS comes from their investment bank. The profits there have surged by 30%. So this is really the powerhouse when it is about making money at UBS. And well, the thing is that this is, when you look at their home market and particularly the little bit difficult relationship the bank has right now with the Swiss government, this is like kind of what people here in the government in Switzerland don't really like to talk about, because the investment bank, it doesn't have such a huge, reputation here in Switzerland.
Well, give us more detail on that, Bastian. What pressure is UBS facing from the Swiss government's capital reforms that it's proposed?
Yeah, we have reported it a lot. There is a sweeping set of bank reforms going on here. The Swiss government is pushing that after the demise of Credit Suisse in 2023. The key pillar of that is that UBS should become more stable, should be safeguarded against any kind of stress it can come under, because the country is aware that it is not going to be able to save this bank alone if it should ever get in trouble. So this is why the plan is, the government is pushing a plan to significantly increase the capital requirements on UBS. They are supposed to rise by some $20 billion, which is something which the bank obviously doesn't like, because it takes money which they would instead like to pay out for shareholders. And there's really a bit of a conflict there with the investment bank of UBS bringing in so much money, but at the same time, like being seen, investment banks, we've seen it in the banking crisis over the past decades, investment banks oftentimes being the source of trouble at banks, of instabilities. And so while the investment banking is bringing all the money, it's not really something which UBS puts forward here, because in Switzerland, which is known for its safety, it is not really what you want to talk about.
All right, Bastian, appreciate you running through all that for us. That's Bloomberg's Bastian Benrath-Wright. Of course, we'll keep an eye on those shares at the open. And Guy Johnson will be speaking to the UBS CEO, Sergio Ermotti, at 7 a.m. London time. Well, returning to geopolitics now, the Wall Street Journal reports that President Trump has told aides to prepare for an extended US blockade of the Strait of Hormuz to intensify economic pressure on Iran. Oil is steady this morning as investors look for any possible peace talks to end the Iran war. Bloomberg's Horizons anchor Jemana Pasechi joins us now for more from the region. Jemana, does the blockade look set to last despite the disruption? We've got conflicting reports here.
That's right, Lizzie. So we're going off this Wall Street Journal reporting. I should say that there's no official comments yet from the U.S. president. And Wall Street Journal is saying that after consultation with many of his security advisors, President Trump has decided that the best policy to pursue right now is to maintain that naval blockade. And we have been reporting earlier in the week that after the Iranian foreign minister's whirlwind trip, diplomatic trip throughout the region, the Iranian side did present a proposal to the U.S. to end the war, which included two phases. The first phase would include a mutual lifting of the blockade around the Strait of Hormuz, and then deferring the conversations around the nuclear file until later. And so the expectation was that we would get a formal White House response. Wall Street Journal saying today that after evaluating all the options, including a possible return to hostilities or even walking away, President Trump has decided that maintaining the blockade is the best course of action because it is, in his eyes, beginning to severely damage the Iranian economy. And one of the stories that we flagged yesterday as well was that Kepler cited the storage capacities of Iran are beginning to fill up. They should be filled up in the next 10 to 20 days. Once that happens, you've removed a key lifeline and a key ability for Iran to support its own economy. The thinking there is that then the Iranian regime would come under more pressure to return back to the negotiating table and perhaps be a little bit more amenable to some of the concessions that the U.S. are asking for on the nuclear file. So as things stand right now, the stalemate continues. The strait is still effectively shut. We are in a state of ceasefire, but again, it is an uneasy ceasefire because at some point the deadlock around the strait needs to be broken. President Trump seems to be signaling that he's comfortable with maintaining the U.S. naval blockade for now.
Now, of course, the geopolitics fed into the UAE's shock decision, Jemana, to quit OPEC, and that appears to have blindsided its partners of 6 decades. You've been speaking to the UAE energy minister, telling you he believed the timing of that announcement wouldn't affect current global markets significantly. Let's just take a listen.
The decision is taken at the right time in our view, because it's not going to hugely impact the market. The market is under supplied, and because of the unfortunate closure of the Strait of Hormuz and the level of inventories that we have.
So that's his take on the market reaction. Jemana, just walk us through the political reaction to this decision from the other OPEC partners.
Yeah, I think there's definitely a little bit of shock that they came out with this announcement, but not a lot of surprise, because we have for years been talking about some of the friction between the UAE and Saudi Arabia. UAE have been pushing for more production. They have been expanding their capacity before the war, pumping around 3.6 million barrels per day. They wanted to get that number to 5 million by 2027, but clearly felt constrained by this collective decision making. What they did see now was a window of opportunity to leave the group without causing a dramatic impact on the market, because the market is so undersupplied given the ongoing blockade around the Strait of Hormuz. And so the reaction in the market tells you a lot about why the UAE made this decision in the first place. They did sense that if they dropped out of OPEC, there wouldn't be that much of an impact today. However, there are a lot of questions about the future, Lizzie, what this means for the remaining members of OPEC, their ability to stabilize prices, their relative influence on the market, how quickly UAE will ramp up production once they can fully start exporting through the strait again. And then, of course, the geopolitical ramifications. We've spoken to several analysts earlier who say that this plays in directly into President Trump's hand, because he's been very critical of OPEC. And now with the UAE, quote unquote, liberated from OPEC, does that bring them closer to the U.S.'s sphere?
OK, a conversation will be continuing throughout this programme, but for now, Bloomberg's Jemana Basetchi, thank you very much. Well, of course, the oil price does factor into inflation. We've got a Fed decision later on today, and traders treading cautiously ahead of that decision. A hold expected, but Fed Chair Jay Powell's press conference will be closely watched, especially for clues on how long policymakers can stay in wait-and-see mode. Let's bring in David Savage now from Bloomberg M Live. David, I wonder, will Powell's future be a bigger question than rates?
Yeah, that's a great point. I think so. I think that'll be the bigger story. I think, of course, there's two things, right? There's the macro story, right? So what's interesting, of course, about the U.S. is that markets are pricing in some expectations of rate hikes rate cuts, I should say, in the back half of 2026. Inflation had been inflecting higher prior to the conflict, and of course, the conflict has accelerated inflation. And some of those impacts are yet to be seen in headline CPI. Of course, fertilizer disruptions, for instance, and the downstream impact on food prices. So, there's certainly a question in terms of what emphasis is put on near-term inflation risk versus longer-term growth concerns. But of course, a lot of the attention will be put on the fact that this is the last conference for Chair Powell as Fed chair. His term ends May 15th, but ostensibly his term as Fed governor runs until early 2028. And so it will be a question as to whether the reversal of the DOJ probe meets his own standards in terms of whether he would be willing to relinquish his seat.
David, appreciate the preview. That's David Savage from Bloomberg Live. Well, let's see how Asian markets are faring now with Avril Hong in Singapore. Avril, what are you watching where you are?
Well, it's about these tech stocks. There is a bit of caution in the markets. Wavering is the word some people have used against the backdrop of those concerns, the Fed, as well as those mega cap earnings. What investors want to see, the Mag 7s, reinforcing the idea that there's strong AI demand, CapEx, especially because the optimism surrounding that is what's been fueling the AI trade in the region of late, especially for the big chip names in the region. Today, you're seeing a bit of pressure on them, including the ones in Taiwan. But we are also taking a look at Flip the Board, what we're seeing in terms of the structural rebalancing, so to speak, right? Yesterday, we talked about how Korea has overtaken the UK in terms of market cap. We've since seen Taiwan beating Canada. So that really tells you how things are changing across markets, a sign of the time, so to speak. Lizzie?
Avril in Hong Kong, Avril Hong in Singapore. Thank you very much for that. Well, coming up, we'll turn back to oil. We'll discuss the UAE's sudden departure from OPEC in more depth. That's next. This is Bloomberg. Well, the UAE's decision to quit OPEC in a matter of days has blindsided its partners of 6 decades. It raises questions about the cartel's future in a time of unprecedented upheaval in this oil market. To discuss, I'm joined by Bill Farren-Price, Head of Gas Research at the Oxford Institute for Energy Studies. Good morning to you, Bill. Thank you for making time for us. I wonder how significant this is for markets that the UAE's exiting OPEC when you've already got so much disruption caused by the Strait of Hormuz.
I think the answer to that is, in the short term, not really much influence at all. Longer term, possibly a little bit, but I think it's being a bit overplayed at the moment. The answer is that the writing's been on the wall that the UAE was uncomfortable, given that it had made the decision, a strategic decision years ago, to boost its oil and gas production, and would ultimately be a volume player more than a price player. And I think that that's what's come to pass here.
Well, many saying that you'll get a structurally looser oil market, but perhaps a bit higher volatility. I wonder if you agree with that, and to what extent you think that this is a win for Donald Trump.
Yeah, that's the argument that seems to be playing out at the moment. But I would say that, if you look at the ability of the UAE on its own to flex production up and down, it's actually quite limited in terms of the size of the global market. OPEC's always really been about what the Saudis do rather than anything else. And I think that will still remain the case. Don't forget, of course, that they're still allied with Russia within the OPEC Plus grouping. And that is a big part of global production, much more so than just the UAE.
So do you see OPEC struggling to keep discipline among the members it still has? Do you see more members perhaps following suit now that the UAE is leaving?
Yeah, that's always a possibility, and we'll have to see how that plays out. But I would think, the elephant in the room really is the Strait of Hormuz closure, and the fact that a lot of these producers are unable to get their oil out to the global market. And I think as long as that situation continues, really, this is an academic discussion. OPEC cohesion only really matters when the market's weak. And we don't see that in anywhere in the near future or on the horizon. So I think the problem is the immediate crisis rather than the delicacies of internal OPEC wrangling.
So, of course, you've got traders waiting for Washington's response to Tehran's proposal to end the war and reopen the Strait of Hormuz. You've got pressure on Tehran, the US threatening to sanction banks that help China buy Iranian oil. How much pressure will that put on Tehran?
I think Tehran's been here before. I mean, they have a well-practiced resistance economy that has endured decades of sanctions. So they're quite well-versed at how to get around these kinds of problems. I think that they will prove to be more resilient than perhaps the White House is expecting. I don't think that they're going to be subject to these kind of short-term pressures particularly. So I think that suggests to me that this standoff over the Strait of Hormuz could actually last longer than many people think.
OK, as President Trump is warning. Bill, great to get your insights this morning. Bill Farren-Price, Head of Gas Research at the Oxford Institute for Energy Studies. Thank you. Plenty more coming up. This is Bloomberg. Some other stories we're following this morning. King Charles has been visiting the US and used an address to Congress to call on the US to maintain its leadership role in the world and to support NATO and Ukraine. The King's unusually pointed remarks came with relations strained by President Trump's criticism of Prime Minister Keir Starmer over issues the war in Iran. Well, the embattled UK Prime Minister Keir Starmer has won a House of Commons vote on whether he should face an ethics probe over Peter Mandelson's appointment with a solid majority. That's the latest from the UK. More next. This is Bloomberg. Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Big banks beat. UBS, Santander and Deutsche Bank all sail past estimates for first quarter net income. We'll bring you our exclusive interview with Deutsche's new CFO in just a moment. Meanwhile, oil fluctuates on a report that President Trump is preparing for a lengthy blockade of the Strait of Hormuz. Traders weigh the UAE's shock exit from OPEC and what it means for the cartel's influence. Plus, treading carefully, investors on tenterhooks ahead of a bumper day of earnings from the US tech giants, as well as a Fed rate decision. Well, it's 6:28 a.m. here in London. Let us just run through the latest earnings from Deutsche Bank. So we have had the red head that first quarter fixed sales and trading revenue came in at 2.85 billion euros. So that is an ever so slight miss on the estimate of 2.87 billion euros. But beats on profit in the quarter as trading has really held up. That as it earned more from asset management and retail banking. Fixed income and currencies is trading, as I say, roughly flat from a year ago. That's slightly ahead of analysts' expectations, though. Revenue at the private bank, which includes retail lending and wealth management, rising about 5%. It jumped 10% at the asset management business, and that offsetting a 3% decline in the corporate bank and a flat result at the investment bank. You've heard already from the CEO, Christian Saving, pledging to lift profitability and boost payouts to investors under a strategy unveiled last year. And now let's hear from the CFO, Raja Akram, who's been speaking exclusively to Bloomberg's chief Europe correspondent, Oliver Krug.
FX has certainly played the headwinds from dollar-euro or year-over-year certainly played a role. That said, first quarter last year was a record quarter for FIC. So I think matching a record performance in these conditions, I think, gives me a lot of confidence that not only have we been able to overcome the FX headwinds, but able to match a fantastic first quarter. Obviously, there's a little bit of a March impact in there that impacted the results, but all in all, I think FIC's held its own.
And looking at the trading risk, drilling down a little bit more into sort of credit, emerging markets, FX trading, that was stronger. What sort of accounted for that strength?
Clearly, we have been investing in our FX business for a while, and it really was managed the risk really well. Like most U.S. banks, we saw rates being a little bit under pressure. But credit and FX continue to outperform our expectations.
And looking at the U.S. banks, also commodities trading did very well. You're having a little bit of FOMO on the commodity side. There has been some talk about Deutsche Bank wanting to sort of re-enter that space more aggressively. Is that something you're looking at?
Oliver, I really like our business mix. Look, I learned from a very smart guy a long time ago that we don't do strategy by envy.
Okay.
So I would say the business mix that we have in the FIC business, but broadly in our asset gathering businesses, I think that's what we really want.
And I'd like to get a picture of so far in this quarter what trading looks like. Has it gathered a bit more momentum? What are you seeing?
Look, clearly April started constructively. I think the jitters that we saw a little bit in March, the market seems to have absorbed and settled into this new rhythm. We'll see where things go from here. It's really early. We're only 1 month in, but I think that the performance that we've seen so far, not just in FIC, but across our businesses, is pretty encouraging.
And what we haven't talked about yet is the great uncertainty, the great unknown, the war in Iran, which, every sort of other day we have a sort of slightly different understanding of what exactly is going on. I'd like to get an understanding for how that factor works its way through the business over at Deutsche Bank. Does it help on the sort of trading side, a bit of volatility, while on the other side, obviously, we see growth forecasts in Germany being radically slashed? How does that work through the business mix at Deutsche?
So it's a little bit of all of the above, but the beauty of having a business mix that we have is that in periods of uncertainty, clients want risk management and advice both on the institutional side, but also on the private side. You saw that in the first quarter, we brought in $22 billion of net new assets across wealth management and asset management, and a lot of that was actually deployed. So I do think in this geopolitical environment, if you have a bank that has the risk management capabilities that we have, for example, on the fixed income side, and then you have the advice capabilities that we have on the wealth management side, it kind of plays to your strength. Clearly, there is a lot of uncertainty around how long this conflict will last, what the impact is going to be on the inflationary pressures that we will not only face in Germany, but also in Europe. On the other hand, there's a little bit more conviction around potentially what it looks like for an interest rate environment. And generally, a higher interest rate environment is beneficial to us. So there's puts and takes of this conflict, depending on how long it lasts. But all in all, I think what we have seen in the first quarter, and we continue to see, is that the bank is now resilient to operate in all kinds of economic environments.
But thinking about, so the ECB's put out 3 scenarios, the base case, the adverse case, and the severe case. What are those 3 cases for Deutsche Bank?
Look, I think the severe case would be that the conflict is prolonged beyond a certain period, and there's a real energy shock, and inflation gets to a point where it really starts impacting growth. Look, the base case would be that the conflict is over, hopefully in the second quarter, from our perspective. There's certainly a little bit of a lag from the effects of it, but I feel that we are in a pretty good situation to deal with, honestly, all 3 of the scenarios. The bank has a really good business mix, and this was something that I found very encouraging coming in, that not only I have a fantastic retail franchise, but I also have a great institutional franchise.
And looking also at credit provisions, I see they're up a bit more than had been anticipated to about 520 million euros. We heard from Jamie Dimon yesterday warning about a possible credit recession. Deutsche Bank also has large exposure into the private credit market, about 5% of your loan book, the biggest within Europe. So what are you seeing within the private credit market specifically? Are you having any concerns there? Is there a conversation about de-risking from there?
Oliver, private credit continues to be a non-story for us. It has stayed at around 5% of our book. It is very well protected. We have great structural protection. We have a very diverse set of underlying borrowers. We have great visibility into collateral. And not only that, we haven't lost any money in this portfolio ever. So I feel very comfortable. As you know, we were one of the first banks to put the disclosure around private credit about the size and the scale of our portfolio. And I'm really glad that the other U.S. banks have now actually, and the European banks have actually followed. And what I see is actually very encouraging, that most banks actually seem to have underwritten this book really well.
So that was the Deutsche Bank CFO speaking exclusively to Bloomberg's Oliver Crook. We're staying in Germany, but turning now to Bavaria. Adidas reporting results in just the past few moments as well. The CEO, of course, looking to win back the faith of investors who cooled on sportswear because of all of this rising geopolitical uncertainty and US tariffs, mind you, as well. Indeed, this result's giving him a bit of ammunition to make that case. So Adidas reporting operating profit for the first quarter that beat the average analyst estimate. The redhead is that we have first quarter operating profit at 705 million euros, so beating the estimate of 647 €7 million. That's supported by strong momentum in apparel, healthy demand for football, running, training products. Fun fact, by the way, both the runners who came in first and second place in the London Marathon over the weekend were wearing Adidas trainers. So this is the shoe that gets you sub 2 hours, it would seem. So lots to be positive about, though, of course, as you can see, the context is shares down about 18% so far this year. We're also looking ahead to lots of tech earnings stateside later on today, but we've already been seeing movement in your tech shares space. This over the past 24 hours as OpenAI has been rejecting concerns over its sales growth after reports saying that it missed several internal targets. The ChatGPT creator labelled the Wall Street Journal story prime clickbait and says its consumer and enterprise businesses are firing on all cylinders. Let's get insight now from our Bloomberg intelligence analyst, Matt Bloxham. So, Matt, good morning. You've got OpenAI really at the heart of this complex web of investment, and that perhaps is why we've seen such a tech sell-off yesterday. To what extent can OpenAI bat off these concerns?
They can try, but I don't think they're going to have much success, to be honest. I mean, I think just even anecdotally, you talk to people the last few months, you hear more about Gemini and particularly Anthropic than you do about ChatGPT. And actually, if you look at recent statements from both companies, when OpenAI closed their recent funding round, over $120 billion, they said that their annualized revenue run rate was about $24 billion. Compare that to Anthropic, that came out a few days later and said that annual run rate was now $30 billion, and it had grown to that very quickly. So you have kind of seen this kind of reordering of the pack, if you like, and OpenAI very much seen as the kind of poster child of the AI boom, being kind of overshadowed by Anthropic. And Anthropic, because it's been much more focused on enterprise applications, not the consumer market, and it's had some incredibly successful models so far. But yeah, this is moving around all the time, and we could be sitting here in 3 or 4 months' time, and the whole pack has reshuffled again, depending on what models get released, and particularly if OpenAI gets some traction on, for example, agentic tools.
So OpenAI kind of vulnerable because of its exposure to consumers. Also, just talk us through what we should be looking out for in these earnings later on. You've got 5 of the Mag 7 reporting.
Yeah, that's right, and 4 of them today. So It's going to be a busy night for lots of analysts, that's for sure, and a busy morning tomorrow, I think, on TV. So, yeah, look, I think the kind of the big connecting theme in all of these is still the growth in cloud revenue, and obviously most of the growth in cloud revenue is coming from demand for AI. And this comes back to what we were talking about before. The $650 billion of capital spending that the Mag 7 are putting into primarily AI-based data centers this year. They have to start demonstrating a return on that investment fairly quickly. Obviously, we saw last week some news that I think Microsoft was going to cut heads, and so was Meta. And so they're having to kind of try to balance books, create some kind of funding oxygen, if you like, to kind of support this growth. So we're probably going to see some margin pressure, or that's where people are going to be focused. And we need to see, very robust cloud revenue growth, kind of in the 25 to 35% year-on-year growth range. And so I think that's the primary focus we're going to see.
OK, you've got a busy 24 hours ahead. Matt Bloxham there. Thank you very much, our Bloomberg intelligence analyst. Well, coming up, more earnings. Volvo Cars earnings declining in the first quarter amid rising competition in the US as well as in China. Stay tuned for our interview with the Volvo Cars chief executive, Hakan Samuelsson, coming up next. This is Bloomberg. Volvo Cars reported a decline in first quarter earnings as the Sweden-based automaker grapples with softer electric vehicle demand in both the US and intensifying competition in China. Hakan Samuelsson, CEO of Volvo Cars, I'm pleased to say, joins me now to reflect on the past quarter and the look ahead. Hakan, thank you very much for making time for us. It seems to have been a bit of a tough quarter for you. What's your message to shareholders?
It is the second half will be better, if a short message. I mean, we are working on a very turbulent market. I think everybody is aware of that, what's happening, geopolitical, tariffs, you name it. And that has, of course, been very negative to our sales volume, especially in the US. I think the decline there has been stronger than we anticipated. I mean, the effects of the discontinued subsidies for electric cars have been very negative for us. We sold a lot of plug-in hybrids in the US, where customers used to get $7,500 as support. And of course, that's taken away. That was negative for US. China was also a very tough market. The local players are taking more and more market share. In Europe, on the other hand, I think we saw a rather stable development and a strong development in the other direction into electrification. So I think it was 26% up on electric cars in Europe.
OK, so a big impact from tariffs. Let's also just talk about the impact of the geopolitics, the Iran war, rising fuel prices. I wonder how that's feeding into your business. Is it that you're seeing customers delaying purchases? Are they sizing down? Are they stepping back altogether from buying your cars?
No, very difficult to say. But of course, it's more a general influence of the business climate, which is not good for us. But we don't see any immediate effect from trade flows restriction or something like that. It's more getting out oil out of the Gulf, which is really the problem. So, but indirectly, of course, you could see also higher fuel prices is probably good for the transformation into electric cars. I think a lot of customers have been reminded now about the cost driving a petrol car, the cost per kilometer. I mean, it's much lower with an electric car. So we see that interest also in US. You can see higher interest for used electric cars to really capture from this trend. But it's something that we haven't seen such a strong volume effect on yet. But I think it will help us to sell electric cars.
Well, it's very timely that you've just launched the fully electric EX60 SUV. What are your expectations for that model in the second half, then?
Very good momentum. We have been launched, really good response, and we are now ramping up. We are looking into to do that as fast as possible. So we will bring out this year around 40,000 cars, and I'm quite sure the problem will not be to sell them. Now the focus is really to ramping up as fast as possible. And I think this comes absolutely in the right timing. There's a strong trend now in Europe towards electrification, 26% up. And then this car will, of course, address maybe half of the segment market in Europe. It's exactly the, say, bread and butter segment in electric cars. And our car is there very strong and is really leader in the segment, I would say. Very long range, very fast charging, and priced on the level of a normal plug-in car. So I think this will be a real good reason for customers to take a second look at an electric car.
Hakan, just finally, your chairman, the Geely founder Li Shufu, recently warned about global overcapacity and said that he wants Geely to use Volvo's European plants instead of building overseas factories. Have you taken any concrete steps already in that direction?
Not concrete, but I mean, it's an option. I think Chinese car makers need to realize that a time when they can just export cars into Europe is gone. So if they want to be strong participant on the market here, you need to have local production. And of course, with the tie Geely has to us, we can of course support them to assemble Geely cars here in Europe or build Geely cars in Europe. So this is an option for them. But of course, a decision must be taken by the Geely brands if they really want to be on that market. But if they want to be here, we can really support them with local production.
Hakan, really appreciate your time this morning. As always, Hakan Samuelsson there, CEO of Volvo Cars. Thank you. Now, to some other top corporate news this morning. In just the past few minutes, Kone has confirmed a Bloomberg story that it's to buy TK Elevator in what is one of the biggest ever private equity exits in Europe. The sale valuing TK at just over 29 billion euros, including debt. A deal is off, though, for Pernod-Ricard and Brown-Forman. They've abruptly ended merger talks that would have brought together the owner of Jack Daniels and the maker of Jameson whiskey. What a cocktail. But they failed to agree on terms. The development may clear the way for a deal between Brown-Forman and another US peer, Sazerac, which, of course, makes Southern Comfort. Now, turning back to earnings, Santander has posted first quarter profit that beat analyst estimates on strong lending revenue and fees. Spain's biggest lender reporting 5.5 billion euros in net income. The strong performance comes amid a US expansion push centred around the recently announced acquisition of Webster Bank for $12 billion. The CFO of Santander will be speaking to us on the opening trade at 7:15 a.m. London time. And staying with earnings, Airbus suffered a steep profit drop in the first 3 months of the year as aircraft deliveries slowed to the lowest since 2009. It's putting pressure on the French-based company to fix its supply chain at a time when rival Boeing regains its manufacturing edge. Adjusted earnings before interest and tax fell 53% to 300 million euros, the company reiterating its forecast for about 870 commercial aircraft deliveries this year. Well, that's a bit of a corporate roundup for you, but there's plenty more still to come on Daybreak Europe, so don't go anywhere. This is Bloomberg.
The president's focused on getting the right deal. That could be independent of their storage, but obviously that puts great heat on Iran. If we can get the right resolution, that could be tomorrow, that could be 2 weeks from now. But what the key thing is the right resolution.
US Energy Secretary Chris Wright speaking there. Well, speaking of energy, let's stay on that theme and bring you 3 charts to frame your thinking for the day ahead. You've seen oil volatility really dropping, though it's still elevated, as you would expect, considering the geopolitical tensions. But we're back to the sort of normal range of madness for this market, shall we say, pricing out panic when it comes to oil. But flip the board over, and the big news over the past 24 hours, of course, has been the UAE dropping out of OPEC. That's set to happen in just the coming days. And we can take a look at the proportion of production that the UAE makes up out of OPEC, the third largest producer of the cartel. But we were speaking to Bill Farren-Price earlier. He says that the departure is pretty much academic and it was expected. So interesting to see, perhaps not so much impact on the oil market when it comes to the price. Just finally flipping the board one more time, and it's a busy day out there for earnings today. In fact, the busiest by market cap for the S&P. So lots to bring you there. Speaking of which, let's turn to the risk events on the docket for today. First off, we've got some inflation data coming at 8 a.m. London time from Spain for April, and at 1 p.m. from Germany also for April. At 7 p.m. London time, we've got that Fed rate decision, followed by what could be Jay Powell's last press conference. Interesting to hear from him, not just what he makes of the policy path ahead, but on his own future if he stays on as a governor, though he isn't going to be staying on as chair. And then we have lots of tech earnings. As I say, a really busy one coming up over the next 2 days. But today we've got Alphabet, Amazon, Meta and Microsoft all reporting. And speaking of earnings, Sergio Amotti of UBS coming up on the opening trade. This is Bloomberg.